by comparison, boutiques, with already their smaller teams, their less human intensity, now have the opportunity to leverage technology to find scalability. Human intensity. This is what finance used to look like. All gone. Take actuaries. Apologies for actuaries in the room. If for the next couple of minutes you wish to peruse your BlackBerry in silent mode, of course, or indeed your iPhone, please feel free. This will pass very quickly. Actuaries, once the overlords of the long-term savings and liability model, unassailable. Yet, in 2016, the Institute and Faculty of Actuaries in the UK, being Scottish, I have a warm regard for actuaries. We are the founding nation of modern actuarial science. The IFA found that they had 29,000 members, which sounds pretty good, right? But 52% of those members were only students. They weren't fully qualified. 73% were aged 40 or younger. An entire generation of 50-plus baby boomer actuaries woke up, smelt the coffee, perused their healthy pension statements, and retired en masse. It leaves that profession in the UK in utter turmoil. It has sought out new revenue streams, like investment consulting, but more of that later. Meanwhile, Martina King wrote for the Actuarial Post. In the insurance sector, reducing the number of highly skilled, highly paid actuaries by replacing them with technology is attractive to companies. To put this in context, Martina King runs an actuarial recruitment agency. She also went on to say there are few open positions for individuals with predictive analytical skills. In other sectors too, organizations are slotting into job ads the request for experience in machine learning. It's worth the investment in gaining these skills to get ahead. Now, I delivered this cheery news to a master's class at University of Actuarial Science students. As you can imagine, they were very happy to hear these words. And yet, Robo is still portrayed as a containable slave, a loyal servant. We make sweeping humanist statements around suitability, interaction, trust, judgment, wisdom, understanding, the fiduciary bond. Yet, the old fund order has progressively pulled investors into a handful of common strategies and failed often to deliver. Strange. However, for big asset management, the old fund order is still good. It offers a number of advantages. For one, size lowers operating cost base as a percentage of assets managed. Post-RDR in the UK, those savings have not been passed on to investors, but to the shareholders. Size builds in margin resilience in lieu of that fee compression. It throws off free cash flow to enable flotation, acquisition, or even the hiring of new talent. It allows for growing marketing and distribution budgets to press home the brand advantage. It pervades our whole industry, active and passive. It is founded on size and the annual management charge. Yet, with big, do indeed come less desirable symptoms. The industry has been slow to address diversity, sustainability, good stewardship, and social responsibilities. Advisors become very attached to star manager bias and safe, well-known options. Today we have too many funds, yet too many assets concentrated into too few. Asset concentration creates supertanker funds, yawing from one market to the next. All the while, more assets, more people. More people gets us right back to Parkinson's law. And asset concentration, being no doubts in the UK, was accentuated by the Retail Distribution Review. And there's somewhere in the region of 85 trillion mutual fund assets in the world today. There's about 20 or so trillion in the US, about 10 trillion in the UK, 15 in Luxembourg, Spain, Germany, France, about 5 trillion each. About 100,000 funds, yet 70 to 75% of that AUM is concentrated in only 10 global groups. The passive rise of Vanguard and BlackRock that we've seen in the United States and across Europe has only amplified and accentuated the problem. Globally, outside of South Africa, ETF providers dominate the sales charts like never before. That domination, again, leads us to consolidation. M&A, consolidation continues. It's all very much late cycle stuff. But when it comes to investing, big is surely good, right? No, not always, not now. The old adage of being big to get the biggest share at the table was from a time when markets were made. They were primary. They were broker-dealer organized. Today we live in a world of secondary markets, compressing settlement and clearing, electronic driven. Big demands more cash. Big demands more margin cover. Big becomes more subject to liquidity and market volatility. Big suffers from rising investor weekly flows, both subscription and redemption. Too much cash and you fall behind. Too little and you become a forced seller in times of stress. Big therefore creates friction, drag, and a lack of agility. When big tries to put large orders through the program trades, it leads to what I describe as yaw, what you might describe as slippage costs. Movements in the bid-offer spreads, spikings of prices, the market price moving around the trade initiation to the trade conclusion. Ideas become ultimately difficult to size into very large funds. Funds like never before have started to gravitate towards indices, or they become quasi-hedge derivative funds. Now, for those interested in this particular area, please check out my Bright Talk. There's one where I cover specifically supertanker funds, ways to think about liquidity analysis on those particular funds. In essence, I had proposed a model that would assess that yaw and slippage. So you could assess relative size to the impacts onto your liquidity analysis. All the while, an ensuing battle between those burgeoning giants and our fair boutiques. For large investors, unfortunately, investing in boutiques we know remains challenging. It asks new questions. We require new syndication models so that we can size appropriately into those boutiques. It supports the use of multi-boutique type strategies and multi-boutique type providers.